You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello, everybody. Welcome back to the podcast. I hope you had a great week. I thought that I would keep on the retirement topic this week and kind of switch gears to the biggest risks to your retirement. So many people anticipate the days when they don't have to work anymore and can finally do whatever they want. Although some wonder what in the world they will do all day, most envision traveling, relaxing, enjoying hobbies, and all of that, of course, is great. However, achieving a comfortable and secure retirement requires planning and awareness of potential risks that could derail your dreams. I mean, think about it. Your retirement years may be just as long or almost just as long as your working years, maybe almost the same amount of years. And although you may expect to need less money when you retire than you needed while you were working, oftentimes the need for income remains about the same. You may be saving money on gas from driving to and from work every day, or maybe you have your house paid off, and that's helpful, of course. But you also won't have as many write-offs in your older years. And if you've successfully saved for retirement so that you have a decent income in your retirement years, then you can't expect to be in a lower tax bracket. And as I point out regularly in this podcast, we have no idea or what our tax brackets will even be when we get into our retirement years. But with the sizable debt that our country is in, higher taxes are not only a possibility, but kind of likely, I would say. And as we went over in last week's podcast, it's important to not only know how your retirement funds will be taxed at the time of withdrawal, but also to make sure you are building pools of savings that you will be able to access income tax-free, so you don't have that tax rate risk on all of your accounts or the majority of your accounts. During the years when you are accumulating assets and savings, the biggest risk is the volatility of the market, depending on what types of accounts you have your money in, of course. In retirement, the biggest risk is outliving your money. The major and most obvious risk would be longevity risk. This refers to the possibility of outliving your savings. Now, isn't that sad? Because, of course, we all want to live as long as we can and enjoy our family and our grandkids and all of that, but that's one of our biggest risks is we live too long. With advancements in healthcare and living conditions, people are living longer, as we all know. While increased life expectancy is definitely a positive thing, it also means your retirement savings need to last longer. Some things you can do to protect against longevity risk are that you can utilize annuities that provide lifelong income, like I've described last week and many times on this podcast. I do like annuities for that income stream. Annuities are a way to basically create your own pension. The main differentiator really between a pension and an annuity is that pensions are funded by employers. They are offered as an employer-sponsored retirement plan from some companies, a lot less companies than there used to be, whereas annuities are funded by individuals. They are contracts between an insurance company and an individual. However, both provide lifetime income that you are guaranteed not to outlive. As I've mentioned before, there are different types of annuities, so you want to make sure that you acquire the type that's fitting for your situation and your financial goals. Another thing you can do is to regularly review and adjust your savings plan to ensure it aligns with your longevity expectations. And once you are in the withdrawal phase, when you're in retirement and now withdrawing income from your accounts, you can adopt a conservative withdrawal strategy from your accounts to help from taking too much and draining it too quickly. Another important risk to your retirement resources would be medical expenses. These are unknown and can be a significant burden in retirement. We don't know what the cost of medical insurance will be each month, and expected health issues and long-term care needs can quickly, and I mean real quick, deplete your savings. To manage the unknown cost of long-term care, purchase some long-term care insurance. You could do this by purchasing an insurance policy that's sole purpose is to protect against long-term care. This type of policy is more like renting coverage, or you could purchase a hybrid life long-term care policy that will leave a death benefit. If you don't end up using your long-term care or not all of your long-term care, it will leave a death benefit to your beneficiaries. Another way you could protect against this risk is by building a banking system using whole life policies. Most every company's whole life policies, or at least the mutual companies I work with or that I've come across, come with some version of a chronic rider that would be activated in the same way a long-term care policy would be activated. By being unable to perform 2 out of the 6 activities of daily living. Those 6 activities of daily living are transferring, feeding, dressing, toileting, continence, and bathing. So if you are unable to perform 2 of these 6 activities of daily living, or if you were to have a severe cognitive disability, as in dementia, then that would activate the long-term care policy that you have or the chronic rider with a life insurance policy that you might have on your contract. Now, again, I can't say every company has this rider, and I don't know that they all call it a chronic rider. Also, it doesn't have to be styled, or your policy doesn't have to be built for the purpose of the infinite banking concept. It can be just a whole life policy. You'll be able to access this rider. It's not that I started off saying, you can build some banking system, a whole life banking system to be able to protect against this risk, long-term care, because it has the chronic rider. But any whole life policy, or most whole life policies, or all the ones that I know of, come with a chronic rider. It doesn't have to be built for the use of infinite banking or for the purpose of infinite banking. These funds that you would have access to from your life insurance policy or the benefits payable from a long-term care policy would allow you access to funds to help pay for assistance, either at your home if you want a home caregiver to come over because you don't want to leave your home, or maybe a better fit would be assisted living. These funds could be used for either of those things, or also even a skilled nursing facility. So if you are buying whole life for the purpose of building a pool of cash from which to finance your future needs, and also so that you will have access to those tax-free dollars in retirement, then you will also be building up the funds that you would have access to in the event of needing long-term care. Different companies have different rules, but what they are allowing is access to a portion of the death benefit if your long-term care benefit rider were to be triggered. Although, again, most companies don't call it the long-term care rider. You could be hitting 2 birds with 1 stone by doing this. However, in some cases, it may be better to keep your long-term care protection separate from your whole life policies and banking system, but at least a whole life policy will start you off with some protection against this risk. In addition to health insurance premiums being at risk of increasing and unknown in your retirement years, there is also the risk of unexpected medical costs. What if you need a major surgery or come down with a major illness? Your share of these costs might be much higher than you anticipated prior to retiring. An HSA may be a good way to help protect from increasing medical costs. HSAs are the only account type that come with triple tax advantages. Your contributions will be tax deductible, the funds will grow tax deferred, and you can access the funds for qualified medical expenses tax-free. Of course, an HSA may not be something that's available to you as well, but those are good for being able to build up your funds and they roll over to the next year so that as you reach those retirement years, you might have a decent-sized HSA to help pay for those unexpected medical costs. So if that's an option to you and it makes sense with your health and how your health is doing, and it just makes sense for a plan for you or your family, then it might be a good way to go. Of course, inflation is another risk as it erodes the purchasing power of your savings. One thing you could do to protect your savings and retirement income from inflation, well, you could start a whole life policy, my favorite thing, designed for efficient use with the infinite banking concept. With the guaranteed growth of the policy and dividends, your policy will become cash flowing, which will help you to keep up with inflation. How the policy cash flows, or if it will, of course, will depend on your age when you start, how much you're funding, your health, all sorts of different things. The structure of the policy that has to happen due to those different things. Also, the death benefit is always much larger, so helps to protect your loved ones as well with the constant rise of inflation. Another reason why it's good to have a policy on both spouses, because if one passes before the other, the death benefit could be very helpful to the survivor. It would help your survivor dealing with the constant rising costs all around them. You also could invest in real estate. I know a lot of you out there that are looking into the infinite banking concept are also excited about combining it with your real estate investments and the plans that you have for that. Well, investing in real estate, it tends to keep up with inflation, whether you are selling properties as income is needed as you age, or you have rental income coming in, and slowly over time, rental income increases as well with the market. Of course, you can invest in equities in the stock market. That can help you with inflation. That is, unless the market happens to tank right before you need your funds. So that option definitely comes with added risk. There are other inflation-protected securities you could look into as well. You could defer your Social Security, since it will be guaranteed to grow at 8% per year each year that you postpone starting it after you've reached your full retirement age, and then up to only to age 70. But it will increase for those few years, either from age 66 to age 70 or age 67 to age 70, or wherever you are in between there, will be growing, guaranteed to grow at 8% per year. So that's one way to hedge against the inflation as well. You can also be regularly reviewing and adjusting your budget to account for inflation. Another risk in retirement would be market volatility. If you're heavily invested in the market, then market fluctuations are a risk. One more, I'm sure pretty obvious risk would simply be insufficient savings. You might underestimate the amount you will need for retirement, which with the risks I just mentioned could easily happen. Many individuals fail to save enough due to inadequate planning or unexpected life events. To ensure sufficient savings, you could start saving early and consistently. Right now, you might feel, oh, I should have started earlier, or I wish I would have started earlier. But either way, just get started. At least just start today. Don't wait and postpone and just think, oh, I'll just save more later. It's best to start earlier. The time is your best friend. The time is your greatest asset. So you want to get started. Another thing, you want to save as much as you can. I know a lot of you have heard, pay yourself first, save at least 10% of your paycheck. And I always just say, just forget all that, just save as much as you can. Because again, with all these risks that are unknown and the fact that you may be living as many years in retirement as you were working, you really just need to save as much as you can. And the cool thing about the infinite banking concept and being able to build that and focus on that and build up your pool of wealth inside of whole life policies is that it allows you to save more, because those funds are not locked up. They're not locked away until you're 59 and a half. And you're also not forced to spend them once you hit 73. And since you have access to the funds, you are able to save way more because you know you can get to that money if you need to or when you might need to. And that in turn allows you to lock in the earning power of many more dollars over your lifetime, which fuels the growth of your savings. Now, one thing you really don't want to do, if you can help it, is to rely too heavily on Social Security. Instead, you should consider Social Security as a supplement rather than the primary source of income. You may have unexpected life events happen. Life events such as divorce, loss of a spouse, or family emergencies can have a profound impact on your finances. To safeguard against such events, you should make sure you have an emergency savings account. That's one of the more common things I'm sure you hear all the time. My emergency savings is, of course, sitting in whole life policies. That's where I house those savings dollars. You can make sure you have life insurance. I've said that at least 3 times in this podcast. People who aren't trying to learn about the infinite banking concept, sometimes they think that they won't need life insurance once they get to their retirement years. However, for most people, it is still very important to have life insurance in place. It will help the surviving spouse once that additional Social Security payment stops if one of the spouses passes first. It will also help with final expenses, which is oftentimes around $20,000, even on the the low costing end of that. It can help the survivor in their later retirement years if he or she has unexpected medical costs or super high long-term care costs. It helps people who have a lot of assets. It can help with estate planning so that the family doesn't have to rush out and sell the business or sell properties right away to get the government their tax money. Another thing you will want to do is, of course, regularly review and update your estate plan. You may want to have a trust in place when the kids are little so that if something happens to you when they're little, you can decide and dictate how those dollars will be spent or how they will take care of your loved ones. Maybe have rules written into your will or your estate plan for your kids that you want to change as they grow up, or maybe you got divorced. It's just important to review your estate plan every so often. And finally, another great way to protect against risks to your retirement is to have a cash reserve. Now, this can be the cash value you have access to in your whole life policy, which of course is my opinion that that's the best place to have your cash reserves. But of course, either way, it doesn't matter where you store your cash. It doesn't have to be a whole life policy. Having that account will allow you to access those reserves in years when you were planning to pull distributions from market accounts in down years, because you don't want to have to pull from market accounts when the market is down. I've said this before, I've said this a few times now. So that will allow you to pull funds from somewhere else. Pulling from a market account when the market is down only compounds the losses. So having another place to get the funds you need will help your market accounts to stretch and last longer. In addition, the cash reserve account will be there for any home repairs or vacations or other needs for large amounts of cash during your retirement years. So at the end of the day, understanding the biggest risks to your retirement and taking proactive steps to mitigate them will help you better ensure a secure and enjoyable retirement. Regularly reviewing and adjusting your plan based on evolving circumstances and goals will help you stay on track and achieve the peace of mind that you deserve in your golden years. Now, if any of this that I went over today has inspired you and you would like to look into and protect the possible risks in your retirement future and you would like to work together, feel free to reach out. You can reach me at valerie@alphaomegawealth.com. I hope you found this information helpful, and I hope you have a great week. Thanks for listening. Take care.
This is thepodcastfactory.com.